Hey guys, so for this week, let's look at the market. And first thing is, this is the current range. So what I drew here is the green box is 400 to 430, the red box is 390 to 360, and the yellow box is 400 to 390. So we're right in the middle of the range, nothing is happening. We try to go up, we try to go down, nothing is taken. And the close on Friday of 395.75 is almost the exact middle of the range, and the market is chopping. It doesn't want to go up, it doesn't want to go down, it doesn't know what it wants to do. Most likely next week it will choose direction, but we can still go either way. Like we have this as the top limiting trend line. We can say this is the bottom one, an overshoot here, but it quickly went back into the range. So next week, most likely we get direction, and we will continue in that direction until April OPEX. I still think it's going to be down, but and I'm not going to explain why in a moment. But take that with a grain of salt. It can go either way. It doesn't have to be up. It doesn't have to be down. Right in the middle of the range, the market doesn't know what it's doing. And we look at the weekly. The previous week we tried to go down, we recaptured. This week we tried to go up, we recaptured. A couple of weeks ago we tried to go up, back in the in the range. And the monthly we reflect that. Like we're right in the middle of the candle. We have a big week up, we have a big week down. The market doesn't know what to do. Quarterly, we we started the quarter here, we went down, we went up, and now we're in the middle of the candle as well. So zones out, let's look at last week's range and the March range. So first thing is we closed March almost exactly at the midpoint, and that's about it. The monthly midpoint is also very close at 394. So this is more reinforcement of the fact that we're in the middle of the range. The market doesn't know what to do, and you have to play it safe. Like don't bet big directionally. Like you can obviously play the range between 390 and 400, but be careful how you do that because if we get a breakout at any moment, you're gonna get squeezed out. Okay, so let's take out these ranges. Sorry, March last week. Let's put this back on. We don't care about the top ones. We don't care about this one. We can hide this as well and put back the weekly range. And let's put back the March range. So our top and bottom limits are the March range. For next week, I mean. Uh, Based on the direction, we can go higher or lower after that. But for next week, let's say we go up, we have 400, the 400 level, we have the bull trend line as an back test, and let's talk about the bear case. The bear case is like this. We're hugging the bull trend line. This is not bullish. It's not bullish because if it was really bullish, it would have recaptured it. So what we're seeing here is basically this setup. If it was bullish, it would be going here directly. Like why would it stop? So this is actually weakness, just like this is strength. Like we were hugging the bull trend line and eventually it went up. If it was truly bearish, it would have gone above it. Let's see if I can find another example. yeah, no, there are some, but on individual names. But this analogy is pretty good. Like, if this was truly bearish, why then does it not go lower? If this is truly bullish, why then does it not go higher? It might go higher next week, but for now it hasn't. And what I expect to see for the bearish case is another attempt to go higher. This should be capped at the weekly high, but I don't think it goes that high as either. So most likely this, another test of 400, and then because it's probably the last push up in the cycle, we get a drop bound to the March low at 380. So similar to this, we went up, we tested it, we had a correction. How big was the correction? 2%. Okay, then we went higher again. It looked good here, it looked good for a duration here, and then we had another correction. And this correction was much larger. Until the low, it was 325, so 13 points. The next one will make a lower high, in theory, and then is going to be much bigger. So the next correction should take us to what is the former bear market trend line. I'll zoom out. So basically this, the former bear market trend line, and possibly hold there. We don't know, and we don't care for now. Why I think it stops here is because quarterly OPEX, no quarterly OPEX, end of quarter expiration. So the end of quarter expiration is pretty big, and I expect that a drop to this level by end of next week, let's say, will get circuit breakered by the expiration. So uh, I don't think we bounce right off and go straight up, but I would assume some consolidation around here for another week or so, and then we start to rally. At the same time, the bullish case is that we take back this trend line. The problem with the bullish case is that there's not a lot of room to go up. So this is kind of the top of the range, and then I think we drop as well. Let's look at the positioning. So first of all, we have the end of quarter expiration. It has a, not this one, sorry, this one. It has a put to call OI of 267, which is uber bearish. And then we have the March expiration, which has 333 put to call OI, which is giga bearish. I don't know. And only then can we get truly bullish for a month or two. But going back to here, just like 380 would probably circuit breaker a move down and prevent it from going further because of the end of quarter expiration, so too will happen for a move up. So if we go, let's say, up next week and we close around 407, then all that bullish momentum goes away, and the magnetic pull of this highly bearish expiration will start bringing us down again. And I would expect the same kind of drop, not to 380, but the same size of drop. So let's say we go for, so it's 20 points. So we are at 407. We would probably go to around here. So assuming we go bullish like this, and then we have another 20 point drop, which would be something like this, lower. So 385-ish, let's say. I don't think it's possible for us to have a sustained move up before um, April OPEX unless we go down first. So if we go down first and then start a move up, we will be able to move up. But if we go up we won't be able to sustain the move up, and we will have another major pullback down by the end of by April OPEX. Now again, my bearish is bias. Let me show you why my bearish is bias. So this is yields. Right now, 10-year yield. Right now, the market is positively correlated with yields, meaning if yields go down, the market goes down. If yields go up, the market goes up. This is not an absolute, but seeing like the market was green on Friday and yields are red, but yields were much redder throughout the day. And if we look on lower time frames, we see that there was a rally at the end of the day for yields as well, and there was a rally at the end of the day for the market as well. For the market, it was much bigger than for yields, but whatever, it doesn't matter that much. The difference for yields is that we have a close below this level. If we look at the weekly, we went below this level several times, but never had a close below it. Last week we had a close below it. Yeah, this is weekly. We had a close below it. It tried to go back up, and now we have an even lower close for the week. So this level, I would say it's lost, and because this level is lost, yields would go much lower. And someone on Reddit asked if I think there will be a rally in yields when the market goes up for May and June, and the answer is yes, but it's yes because yields will go much lower. And if yields go much lower, then it means the market is fucked as well, because they are positively correlated right now. So the next level for yields is around here. This is on the weekly, on the daily. Yeah, this is about right. Maybe let's do the daily levels. So let's put it like this. So we even have a daily close. We had a couple of ones before and they were saved. But even in the context of this saving the market and the market going up, yield going up is not good for the market right now. Because in very short order, there will be another recession scare and they will crater again. And when they crater, they are positively correlated with the market. The market will crater as well. So what I think happens, its yields continue to go down. They will go down to 2.9, 2.85-ish. And only then can we have a rally that is sustained. So it will go down, they remain positively correlated, and then we start going up, but from 2.9, not from 3.4. Going up for 3.4 is the case that I said that is short-term bullish, but it cannot be bullish like this thing here. It goes up and then it still craters 20 points. That is the case where yields go up next week. My bad. So I don't think yields go up. I think they go down. And we start the rally up to maybe here later on. So let's look at the other indexes. So this is Qs. Let's see where it is. Like this. I don't know, let's do it like this. So double wicks with lower highs. Now the candle, ignore the candle, what you should be looking at is that it's another lower high. And if we go to lower time frames, we can do this. And this is kind of what matters. I would say this is not bullish. And what we saw on Friday is the market was somewhat bullish, but in the context of this is RSP. RSP is equal weight SPX. And equal weights SPX versus, let's compare it with US 500. No, with, I don't know, SPX. Did not perform as well. XPX on a relative basis is uh, is performing better, and that is because of mega caps. This is, oh, I was looking at weekly. This is RSP over SPX, and as you can see, the majority of stock compared to the performers, uh, which performers were the mega caps, because one is equal weight, what is not, one is the other is not equal weight, was severely biased towards mega caps. So all of the market gains in the past month have been due to mega caps, not because of the market performing well. And what we saw on Friday was a small bump in RSP, and also RSP outperformed SPY, so 0.85 versus 0.66, and also outperformed Qs by a lot because mega caps are also Qs, so 0.47 versus 0.85. So what I think is going to happen in the future is we'll get a couple more days of this type of behavior, meaning the market is almost flat, slightly up, slightly down, doesn't really matter, but between 0 minus 0.5 and 0.5, in which uh, your usual stock performs well because money is moving from mega caps into the rest of the market, and mega caps perform relatively poorly. Not poorly by a lot, but underperform the market. On Friday it was mixed. Like Tesla was down, Apple was up a bit, Nvidia was down, Google was down but very small, Microsoft was up but not by a lot either. Amazon was down small, Facebook was up small, Netflix was up but whatever. Netflix isn't that big, and I think we will continue to see this kind of mixed thing in which if a mega cap is up uh, bigger, it has to, like the mega caps as a whole, if we add this up, it's going to give us like something like zero. Like Microsoft and Nvidia cancel each other out, Tesla and Apple cancel each other out, Amazon and Google and cancel Facebook out, and so on, something like this. So mega caps overall are probably going to be flat or down, but not a lot, until the moment where they are down big. And when the moment they are down big, the market won't be able to stay flattish green. At that point, the mega caps start drawing everything down with them, and the market will start dropping. But while the market drops, I expect non-tech stock to perform better on a relative basis. Like for example, energy might go up. Uh, I don't know, materials might go up and so on, at least short term. Something like that might go up. Uh, Industrials, generally speaking, should start to recover a bit on a relative basis. But that will not last long. That's just the period before the drop. So a couple of days in which mega caps are overall flattish, slightly red, and the rest of the market is up, slightly green. And when the mega caps start going down for real, it it makes the entire market drop. And this is the moment we've been waiting for. Um, yeah, that's kind of it. Let's look at mega caps briefly, and then we'll call it a day. So Tesla hugging this trend line, not going above it, looks like a rejection. So one rejection, another rejection with a lower high, and then an even lower high. So Tesla says it wants to go back to this level at least. Apple, so Apple is very similar. Rejection, rejection, not a rejection, but lower high. So the upside for Apple is 165 at max, if it even can do that. But uh, I doubt it will have the ability to push higher. And then correction. Let's see when the moving indicators are. At least the 20 MA tag, which is it's very overextended compared to its 20 MA. Nvidia, same situation. The first sign of weakness, at least a 20 MA tag, which is 244. Let's say it goes to 250, but even that is much lower. Google into horizontal resistance. Microsoft into horizontal resistance and at gap fill. Microsoft has been outperforming stuff a lot lately, so I think it actually fills the gap to 240, 285. It's 280 now, so another $5, but it might do it in a single red candle. Like it goes up, it fills the gap, and then it closes back below 279 in the same day. Amazon into horizontal resistance. This was a strange overshoot because of earnings, but it quickly went back below it. So in a single day, it was back at this level. So I say this level is much more significant than the fact that it overshot here. So Facebook at horizontal resistance. I also think this is an overshoot, and it will get back below to 200 or at 200 relatively shortly. And Netflix looks like just a backtest. So this is very similar to the SPY single day recapture, and it was followed by a red candle the following day. So to recap, we are in the middle of nowhere. The market has not chosen direction yet. Then this trend line is capping our move up. If we go up, I expect 400 will reject us. And I show that with the other stuff as well. Oh, sorry. Then I think this is the trend line, or let's put it like this, but I don't like it like that. This is an overshoot. Come on. Like this. This is even better. So these are the trend lines. If we go above it, it's a breakout. If we go below it, it's a breakdown. If we go above it next week, target is 407. We don't have a lot of room to go, and I think we get a 20-point pullback after that. If we go down next week, I think we stop at 380 for next week. A weekly close or a monthly close at 380 would look very, very bad for the market. Like it would be a red candle with a wick up, a huge red body. So we might continue down a bit lower. But I think any move down is capped at around 370. And time is running out for us to push it lower than that. I expect that put to call OI will improve a lot if we go down to that level. Let's look here. So for May it's still 226, but for June it's 184. And overall now it's 208. Overall, after April expiration, it's going to be 167, and this is 207. This is put to call OI, and this just looks like a consolidation for before a breakout. VIX also has like a somewhat bullish look. This is daily. What am I doing? It's been in a major downtrend. It's curling up. It's at support. So chances are it goes up next week. I really want to see that move down, because otherwise I cannot trust a move up. So unless we get the move up, keep shorting spikes up. The move, unless we get the move down, keep shorting spikes up. And you see the levels. Anything above 400 is shortable, and expect at least a move back down to the trendline lows. That's it. Have a good week. Bye bye.